Coming up on today's show, the US dollar keeps pumping and what it means for stocks this earnings season. Donald Trump is paying attention to the market. Meta falls 3% on news it's becoming more efficient as a company, and why this chart is all we need to pay attention to for the next 3 months. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were mixed on Tuesday as investors took in the first of two key inflation reports this week, which showed prices rose less than expected in December. Also in focus was a report that the incoming Trump administration could hike tariffs more gradually to ease inflation pressures. And this was fairly good news in the market, particularly in the morning. Stocks were very green, but we saw them towards the end of the day pull back. And that pullback was led by the mega caps, particularly Nvidia, Microsoft, Apple. They were pretty red. Same too with Meta, Google, quite a bit of the big names here in healthcare, Amazon, Tesla, Walmart, and Costco. So generally speaking, these large mega cap names really took it on the chin. But the broader market, excluding the healthcare segment right here, was actually very green, guys. Look at financials rallying on the back of the mega banks reporting earnings tomorrow and financials kicking things off. We saw positive momentum in real estate on the back of KBH Homes earnings report. Utilities were green, energy was green, basic materials, industrials, right? Even certain parts of consumer cyclicals, the stuff right here, home builders, right? Very, very positive momentum. And then we also saw infrastructure technology as well as software as a whole buck the technology trend and the red trend we saw in the mega caps, and they were pretty green. In fact, it was a great day, a broad-based day with very, very solid gains across the board. But what really held the market back was actually just some of these tech names, right? Look at the XLK, look at the XLY, look at the XLC. They were some of the worst performing sectors today, with healthcare being the worst. And we saw the SPY was kind of just flat today, down 0.22%. But you have a look at the broader market, real estate, energy, financials, industrials, materials, utilities. They were all up deep in the green on great volume today as well. And when you look at the broad market, small caps and mid caps really outperformed today. In fact, small cap value and small cap core really put on a show, up 1.29% and 0.9% respectively. We saw roughly the same trade in the mid cap sector, up 1.14 and 0.8%. And in fact, large cap core and large cap value were also relatively green, with the only red spot being this large cap tech space. And that is why the market as a whole, the S&P 500 and the Nasdaq 100, was slightly less upbeat than the broader market. But we are starting to see that value trade, that value rotation, that broad market rotation come back into focus, especially with small caps and mid caps putting on a show in the last couple of days. And that's something that we've noticed over the last few weeks. We said that value trade is coming back. And we also saw that globally. It was a fairly green day, except here in South America, the United States, and then the Southeast Asia, which is largely just a bunch of like semiconductor manufacturers, and then Japan in the red. Everywhere else was green, from China to India. Most of Europe was green, South America, and then Australia. But all in all, if you exclude the US, if you exclude US large caps, we had a very positive day across the board. And it all stemmed from the PPI report. Wholesale prices rose less than expected in December, a positive sign for the economy amid recent market fears that inflation isn't falling as quickly as hoped to the Federal Reserve's 2% target. Today's report from the BLS showed that PPI, which tracks the price changes companies see, rose 3.3% from the year prior and up 3% from seen in November, but actually below the 3.4% consensus estimate. And that means inflation is actually cooling a little bit more than expected. On a monthly basis, we saw PPI rise 0.2% against the consensus estimate of 0.3%. And this simply helped calm some of the fears that the US is experiencing a inflation resurgence that could come on the horizon. This is very, very good news, and it actually bodes very, very well for the CPI report that comes tomorrow, it's very likely that we probably are going to see an in-line, if not cooler than expected CPI report based on this PPI data that we're seeing right now. What also sort of helped stocks and the markets, particularly US stocks, rally into the open was a report that Donald Trump's team is considering a month-by-month rollout of promised tariff increases rather than imposing higher levels in a single move. Now, Trump's proposed policies right now include high tariffs on imported goods, tax cuts for corporations, and curbs on immigration. Those have led to more bullishness around the dollar, largely due to their protectionist nature. Most economists agree the bulk of those policies, especially Trump's tariff plans, will lead to higher inflation over time. And it's very clear that Trump's team is sort of getting the message. Maybe it has to do with Scott Bessent and some of the people he has around him, and they're sort of easing market fears. And this is what you want to see from an administration that's keeping its eye on the stock market and the financial markets as a whole. And as a result, on the back of this, the dollar fell, sort of like a vote of confidence from this report with regards to the market. But let's actually talk about some of the market movers apart from the US dollar and what was on the news cycle. Now, Meta was down 2% on Tuesday after the company confirmed to multiple outlets it would cut about 5% of its staff, mostly its lowest performers. Now, I don't know why the stock was down 2%. Wall Street should be giddy up on that news that they're cutting staff and increasing efficiency, but Meta was down 2.7% today. Now, quantum computing stocks out of nowhere rallied. They were up 38%. There was virtually no news today, but they were down 50%. So maybe somewhat of a dead cat bounce. Nonetheless, a lot of people made a lot of money in quantum computing, especially if you were a day trader today. And guys, on the earnings front, KB Home, a home builder, rose 4% on Tuesday after the home builder posted better than expected earnings per share and net orders despite elevated mortgage rates. The company reported fourth quarter earnings per share of $2.52, topping Wall Street's estimates of $2.44 a share. Net orders reached 2,688 during the period, a 41% year-over-year gain, and this is also above the consensus estimate of about 2,550. However, executives noted a shift in demand as some buyers hesitated on their purchase decisions, particularly in the last 2 months of our quarter, amid some of the volatility they saw in mortgage rates. But looking ahead, KB Home expects a full-year gross margin of 20 to 21%, assuming market conditions continue, and they will continue to offer mortgage concessions such as rate buydowns to secure more deals. And there will be no significant change in their home buyer concession policy amidst affordability issues. So long story short, the housing market is still in good nick, but there's definitely concerns under the hood with affordability, and home builders will need to continue offering these concessions, buy downs, and incentives to keep buyers coming in. Great earnings, a good precursor to home builders, but we'll see when some of the bigger home builders report what that's going to look like, and some of the banks tomorrow, we get their commentary as well. But for all intensive purposes, guys, for everything we saw in the market, we actually had great breadth, 3,700 advances, 2,500 decline. Nonetheless, market momentum is starting to take shape. We actually did see the 5-day moving average recaptured today. Very, very good. Yes, it is noisy, so we generally try to ignore it, but we did see continued improvement from yesterday, from the 20-day all the way to the 200-day. And if we can start recapturing some of these moving averages, we will see momentum continue. And it does look like we are somewhat trying to put in a bottom here in the equity markets, particularly in the US stock market. Nonetheless, market breadth looking solid, market momentum also looking solid. We just need to see continuation of this momentum coupled with good CPI data. Diving into the charts, guys, we see some very, very interesting developments, very mixed price action. The IWM and the RSP for a second day in a row, outperforming the S&P 500 and the Nasdaq 100. In fact, the S&P 500 looking to close ever so slightly positive on the day, We're about 2 minutes from market close. Nasdaq 100 on the back of the mega caps down 0.66%. In fact, the best performing asset here today is actually profitable small caps, the S&P 600 as well as mid cap. And so we are starting to see that very clear broadening out. We did see today the dollar down 0.24%, and we did see yields mixed as well. The 30-year yield was up, the 10-year yield and 2-year yield was down, the 30-year yield nearly at 5%. I think it may have touched 5% today. Again, bonds were mixed, AGG was flat, TLT was down, and we actually saw commodities, gold, silver, nat gas, all up today. Bitcoin up 2%, nearly 97,000 level, and WTI was down 2.34%, just shy of the $80 per barrel, at least for WTI. But all in all, guys, we continue to see positive momentum and positive price action for equities in terms of putting a bottom. We are finding support in the S&P 500 right here at this Trump gap up. We are now seeing positive market developments moving onward and upward. And what we really want to see by the end of this week with positive market data is a recapture of the gamma flip right here and consolidation. If we can get that, that probably means we go higher into the end of January, into February. However, if we don't recapture this in the next couple of weeks and we see support below, we probably will go lower for the S&P 500. So this 58.95, call it the 5900 level, is absolutely key. The same is true with the Nasdaq 100, right? You can see this gamma flip is absolutely key. Call it the 21,200 level. We want to see the exact same thing, a rally up there, recapture, consolidate, and then make the next move higher. If that isn't the case, we probably go down from there back to the put support and maybe even lower levels. So the markets, especially large caps, they're trying to put in a bottom, but just struggling with some of these bigger names like Nvidia. However, things looking very constructive for the RSP. This is genuinely looking like some form of a bottom we're putting in, and it's not just the RSP, right? And the same is true for the RTY. This is somewhat looking like a bottom. This is looking like the capitulation, and we are actually at the point of recapturing the gamma flip. So getting into positive gamma, and you know what that means. The second we're in positive gamma, we buy dips, sell rips all the way to the core resistance level. And if we see some of these levels move up in the next couple of days, that would be very, very positive. So things looking extremely positive for the Russell 2000, smaller caps, mid caps, profitable small caps, the broader market, the RSP, very, very solid. Now we just got extended hours trade. Look at the IWM up 0.15%. The RSP is flat. Qs up 0.17% as well. So if you actually take the trade we saw in the Qs and the extended hours, you know, the QQQ or the Nasdaq 100, according to this ETF, because this is the tradable ETF, is actually positive on the day. However, the Nasdaq 100, which is just the index, right? This is actually only down 0.52%. Nonetheless, guys, we're seeing very positive developments in the market. The Russell 2000 and the RSP looking like they actually want to go higher. The Russell 2000 in positive gamma. However, a little bit of work to be done in stuff like the Nasdaq 100 as well as the S&P 500. Although we are starting to see the very early signs of a bottom, and we're starting to see breadth expand, volume come into the market, and that's coinciding with positive market data. Look at the PPI. If we get solid bank earnings and solid CPI tomorrow, we could definitely see large caps push up into positive gamma. And if bank earnings come in solid, that's going to bode well for the RTY as well, because 30% of this index, or just under 30% of this index, is regional banks, right? These regional banks can do very, very well. We did good bank earnings. That's going to bode very, very well for market momentum. And then we can actually retake the positive gamma zone right here and then consolidate above it and make the next move high. So this is starting to look like a bottom. Still a little bit early to call in the larger cap names, but in the RTY, it's very clear. It's looking like a bottom. Same with the RSP. In fact, the RSP looks very, very constructive, and we just have to retake these highs, and then we would signal trend continuation here in the RSP. Very positive developments, guys. I really, really like what I'm seeing in the market right now. However, we are still in a wait and see mode, and a lot is dependent on the CPI. We get a cool CPI, stocks are going to rally, but if we get a hot CPI, things will get very, very ugly. A lot is dependent on earnings and CPI tomorrow, so definitely pay attention to those. Everything is riding on the data we get tomorrow. This is CNN's Fear and Greed Index, guys. We're going to look at sentiment, and we are still in the fear zone. We've been in the fear zone for the better part of about 2 to 3 weeks. And what we've seen lately is that we are slowly approaching the extreme fear zone. And the second sentiment starts going into extreme fear, you need to start thinking about a bottom forming more than any other type of price action. The second fear gets extreme, we are closer to a bottom than anything else, and you want to start buying the dip. So start deploying capital, guys. I certainly have. And if you follow me on Twitter, since the 2nd of January, I've been very consistent on this, that we are going to see a bottom form in Q1. And I've said that that bottom is going to form in January. I said the S&P 500 will bottom at around this level. It's not an exact science, but at that level between this date right here, the 10th and the 18th of January. When I posted this, the S&P 500 was $5,900, almost flat, 5906. And what have we seen in the last couple of days? We've seen equities come off their lows. We've seen fear and sentiment capitulation, and these are early signs of a bottom. What we need now is follow through to the gamma flip zones, retake those gamma flip zones, and then it's onward and upward from here. Do expect volatility though, guys, because the US dollar just keeps pushing higher. Guys, the Fed cut rates right here. The US dollar has been on a tear. It has seen an 8% increase, nearly at a 110 level. That is absolutely crazy. And as the US dollar has risen, so too has yields. The 30-year yield actually hit 5% of yield in the last couple of days. It has since come down ever so slightly, but a stronger dollar and stronger yields, not really good for the market. And when you look at the sensitivity of sales growth in a stronger US dollar environment, more sectors see a stronger US dollar as a headwind relative to those that actually see it as a tailwind. In fact, financials and utilities see a strong US dollar as a tailwind. Every other sector sees it as a headwind, including the big sector information technology. And as a result, you can see right here, the S&P 500 sees a stronger US dollar as a headwind net. However, the market has actually really started to discount this into 2025 earnings. We've seen downward earnings revisions in the S&P 500, but also in the topics, the stock 600, as well as emerging markets. So because of the stronger dollar, we've seen downward revisions in everything, and the market is pricing this as a result. However, guys, you do have to understand that when we have a stronger dollar, investors often look past FX headwinds, and companies that miss revenue estimates due to foreign exchange headwinds, their stocks don't underperform the market nearly as much. So investors generally look past FX headwinds. You're going to see a lot of companies and a lot of management teams post a constant currency tab, and that's going to show without the strong US dollar, this is what we would have made. And I think the street and the market are going to look at that as a result. But all in all, guys, a stronger US dollar is just indicative of the macro environment. The macro is very, very strong. We're still seeing real GDP growth of about 2.3%. GDP had their Goldman Sachs GDP Q4 forecast was left unchanged at 2.4%, very strong. We have since seen the economic surprise index bounce back to the zero line. This is the zero line right here. We are pretty much unchanged. We've oscillated up and down in the last 12 months, but net, the macro environment is very strong, and we're neither missing in a big way or beating in a big way. The macro environment is just right. Call it Goldilocks. And when you look at the consumer, federal tax receipts sitting at 15.2%, that is huge growth, guys. And we may be heading into a period over the first half of 2025 where the US dollar actually strengthens a lot more. Treasury yields at the long end stop rising and maybe even fall. As a result, commodities come under pressure, all due to booming federal tax revenues and maybe a complete TGA drain due to the looming debt ceiling battle. And generally speaking, this means we probably issue slightly less debt than expected. Yields come down, commodities come under pressure, but we still maintain dollar strength because of the robust domestic economy we have. Now, I could be wrong with that, but that's definitely something we could see. And if we do see that, I think stocks will perform well, particularly because of how sensitive stocks are to yields. And you should see that smaller mid-cap, the broader component of the market, outperform relative to some of these mega caps with large international diversified revenues. But on the topic of earnings, guys, tomorrow we officially kick things off. We have JP Morgan reporting before the open, Citi, BlackRock, Wells Fargo, Goldman Sachs, BNY Mellon. They are all reporting before the open. And that's pretty much it. Then on Thursday, we have TSMC, United Health, Bank of America, Morgan Stanley, US Bancorp, First Horizon, PNC, M&T Bank, Infosys. So Wednesday, Thursday before the open, it's going to be two very big days. Now today we got PPI and tomorrow we get CPI, core inflation rate, as well as the headline figure. And what we're looking for, what you really want to look for is this core month-over-month figure, negative 0.1%, and the year-over-year headline figure of 2.3%. Guys, if we hit these targets, Bob's your uncle. We're off to the races. That will be the signal for equities to rally, and then we have put in the bottom. I have started deploying capital in this market on the basis of that I think inflation is actually going to start cooling in a very significant way over the next 2 quarters, and I'm playing that as a result. So I have been buying the dip here and there. You know my stance. I think we're going high into 2025. All of this is just noise for the bull market that will continue. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.